For decades, silver has been the overlooked metal, the poor man's gold, trading in the shadow of its more glamorous counterpart. But as we enter 2026, the narrative has violently shifted. Silver is no longer a quiet hedge. It is the epicenter of a financial earthquake. In the third week of January 2026, the price of silver surged past the $110 per ounce mark, hitting $117 in some global markets, a move that has stunned analysts and rewritten the history books. This is not a gradual climb. It is a parabolic spike, with the metal gaining nearly 50% in the first month of the year alone. For context, the previous nominal all-time high, set during the speculative frenzy of 1980 and nearly matched in 2011, was less than $50. The current price is more than double that historical peak. But the price is only half the story. The true tension lies beneath the surface in the concrete vaults of the world's largest commodity exchanges. In that same week, data from the COMEX, the primary U.S. futures exchange, revealed a shocking development, a single-week plunge of 26% in registered silver inventories. This is the metal designated for immediate delivery, the physical supply backing the massive paper market of futures contracts. This is the core issue, a fundamental mathematical disconnect between the paper promises of the financial system and the physical reality of the metal. The question is no longer if silver will break the $120 barrier, but when the paper market, built on the assumption that only a fraction of contracts will ever demand physical delivery, will finally break under the strain of a genuine physical short squeeze. The stakes are immense, not just for traders, but for the global economy, which relies on silver as a critical industrial component. This is the story of how the world S most manipulated metal became the world S most urgent financial emergency. To understand the current price explosion, we must first recognize that silver is no longer primarily a monetary metal. It has become a strategic industrial asset, a critical component in the world's most important technological revolutions. This shift is the fundamental driver of the structural supply deficit. For the last 5 consecutive years, including 2025, the silver market has run a supply shortfall. The Silver Institute reported that total industrial demand reached a record high, driven by 3 primary forces. First, the solar energy revolution. Silver is an irreplaceable component in photovoltaic cells, with global solar PV capacity forecasted to reach 665 gigawatts in 2026. The demand from solar panels alone is projected to consume between 120 and 125 million ounces of silver this year. This is a massive, non-negotiable demand sink that grows exponentially with every new solar farm. Second, the AI infrastructure build-out. The massive expansion of data centers, high-performance computing, and artificial intelligence requires vast quantities of silver for its superior electrical conductivity. Silver is essential in the switches, connectors, and semiconductors that power the AI race. This demand is accelerating, turning silver into a technology metal on par with rare earths. Third, electric vehicles, EVs. An average EV uses significantly more silver than a traditional internal combustion engine vehicle, primarily in its electrical contacts and battery management systems. As the global auto industry transitions to electric power, this demand floor is permanently raised. The problem is supply. Unlike gold, which is primarily mined for its monetary value, approximately 70% of silver is a byproduct of mining for other base metals like lead, zinc, and copper. This means that the supply of silver is inelastic. It cannot respond quickly to a sudden surge in silver-specific demand. Even with the price of silver soaring past $110, it takes years to develop a new primary silver mine, and the majority of new supply remains tied to the output of copper and zinc mines. Furthermore, the grade of silver ore being mined globally has been in a secular decline for over a decade. The structural inelasticity means that the current industrial demand is simply unsustainable against the current mining output, creating a permanent widening deficit that is now being exposed by the price action. The Silver Institute's data confirms that the market has been in a deficit for 5 consecutive years, and this imbalance is the bedrock of the current price shock. The silver market operates on a massive scale of leverage, often referred to as the paper market. This system is centered on the COMEX, where futures contracts are traded. For every ounce of physical silver held in the COMEX vaults, there are dozens and sometimes hundreds of paper claims against it. This system works only under one critical assumption, that the vast majority of contract holders will never demand physical delivery. They are speculators, not stackers, who are only interested in the price difference. This leverage allows large financial institutions, the commercials, to sell massive amounts of silver futures, effectively creating an artificial supply that keeps the price suppressed. This practice has historically been the source of market manipulation claims, with several major banks paying over $1.3 billion in fines for manipulating the silver market in the past. The short squeeze narrative, which has gained immense traction among retail investors since the 2021 movement, is the direct challenge to the system. The goal is simple: to demand physical delivery of the metal, thereby forcing the paper market to collapse under the weight of its own leverage. In late 2025, the total warehouse stock at COMEX was approximately 127.6 million ounces. However, the critical figure is the registered inventory, the metal that is actually available to satisfy delivery demands. When this registered stock plunged by 26% in a single week in January 2026, it signaled that large, sophisticated players, not just retail investors, were taking physical metal out of the system at an alarming rate. This is the moment the paper market's foundation began to crack. The rapid depletion of COMEX registered inventory is the most urgent signal in the silver market. This is not a theoretical problem. It is a mathematical crisis unfolding in real time. When a futures contract holder decides to take physical delivery, they are essentially removing an ounce of silver from the system forever, or at least until a much higher price incentivizes them to sell it back. The 26% drop in registered inventory in January 2026 means that a significant portion of the immediately available supply has been claimed. The key danger lies in the paper-to-physical ratio. This ratio, which represents the number of paper ounces traded for every physical ounce available for immediate delivery, is now at an extreme, potentially unmanageable level. For example, if the ratio is 100 to 1, it means 100 investors hold a claim on a single ounce of silver. The massive open interest in silver futures, combined with the 26% drop in registered inventory, suggests this ratio is at a breaking point. If even a small percentage of the remaining contract holders decide to stand for delivery, the COMEX would be unable to fulfill its obligations, triggering a force majeure event. This is the ultimate risk for the commercial short sellers, who are now facing a mathematical certainty that they cannot cover their positions with physical metal. The only way out is to buy back their paper shorts, which is precisely what is fueling the parabolic price move. This is the definition of a short squeeze. The large commercial banks who are net short on silver futures are now facing a shrinking pool of physical metal to cover their positions. To avoid default, they must buy back their short contracts, which drives the price up, which in turn forces more short covering, creating a self-reinforcing upward spiral. The price surge past $110 is the direct result of this forced buying, a desperate scramble for physical metal that is simply not there in the required volume. The bearish counterargument is that the COMEX can simply change the rules, offer cash settlement instead of physical metal, or that the registered inventory will be quickly replenished from the larger eligible inventory pool. However, the market's reaction, the price surge, suggests that investors are no longer trusting the paper solution and are demanding the physical asset. To gauge the potential for this squeeze, we must look at the historical precedents, but with a critical eye on the differences. In 1980, the silver market experienced its most famous spike, driven by the Hunt brothers' attempt to corner the market. Silver soared to nearly $50 per ounce. That event was purely speculative, driven by a single family's attempt to manipulate the supply. When regulators intervened and margin requirements were changed, the price collapsed. In 2011, silver reached $14.50 per ounce during the post-financial crisis rally, fueled by quantitative easing and a flight to safety. This was a monetary event driven by inflation fears and a weak dollar. The 2026 surge is fundamentally different. It is not driven by a single speculative family, as in 1980, nor is it solely a reaction to quantitative easing, as in 2011. It is a confluence of three powerful non-speculative forces. 1. Structural industrial demand, the non-negotiable need for silver in solar, AI, and EVs, creating a permanent demand floor. 2. Monetary devaluation, the ongoing fear of inflation and the U.S. national debt, driving investment demand. 3. Physical inventory crisis, the COMEX drain, a factor not present to this extreme degree in 1980 or 2011. The fact that the price has already surpassed the nominal peaks of 1980 and 2011 by more than 100% suggests that this is not a cyclical rally, but a structural repricing of a critical asset. The 1980 and 2011 rallies were primarily driven by speculation and monetary policy, respectively. The 2026 move is driven by consumption, meaning the metal is being permanently removed from the market and cannot be easily returned. This fundamental difference is why analysts believe the current price floor is significantly higher than any previous peak. The historical context shows that when silver moves, it moves violently, but the current move is backed by a fundamental supply-demand imbalance that was absent in previous bubbles. Less. The immediate focus for traders is the $120 per ounce level. This is not just a round number, it is a critical technical and psychological barrier. From a technical analysis perspective, breaking $120 would confirm a parabolic breakout into uncharted territory. With no historical resistance levels above this point, the price discovery mechanism would be entirely driven by the speed of the short covering and the intensity of the physical demand. Analysts are already projecting targets of $150 and even $200 once $120 is decisively breached. From a psychological perspective, $120 represents the point of no return for the paper market. A sustained move above this level would signal to the broader financial world that the COMEX system is fundamentally broken and that physical silver is the only asset that matters. This could trigger a massive rotation of capital from paper assets into physical bullion and silver mining stocks, accelerating the squeeze. The bearish interpretation warns of extreme volatility and exhaustion signals. Silver's rapid 50% gain in January 2026 has created a highly overbought condition. A sharp, temporary pullback, a shakeout, is highly probable as early buyers take profits. This volatility is the primary risk for new investors entering the market now. However, for the squeeze to truly fail, the COMEX would need to see a massive, sustained inflow of physical metal, a scenario that seems unlikely given the current industrial demand and the structural supply constraints. The silver squeeze is not happening in a vacuum. It is being amplified by two powerful macroeconomic and geopolitical undercurrents. First, the Federal Reserve's policy. While the Fed is attempting a soft landing with projected rate cuts in 2026, the underlying fear of inflation remains high. The massive U.S. national debt and persistent fiscal deficits continue to devalue the dollar's purchasing power. Silver, as a traditional store of value, is a direct beneficiary of this monetary uncertainty. The price surge is, in part, a vote of no confidence in the long-term stability of fiat currencies. Second, geopolitical de-dollarization. The trend of central banks in the expanded BRICS plus bloc diversifying their reserves away from the US dollar is accelerating. While gold remains the primary focus, silver is increasingly being accumulated as a strategic reserve asset due to its dual role as a monetary metal and a critical industrial input. This institutional buying provides a powerful, non-speculative floor for the price. The move by these nations is a direct response to the weaponization of the dollar in recent years. By accumulating physical silver, they are not only hedging against inflation, but also securing a vital industrial resource, positioning silver as a hedge against global instability and a key asset in the shift toward a multipolar financial world. This macro-level demand is a new, powerful force that was not a factor in previous silver rallies. The confluence of these factors means that the silver price is being pulled higher by both micro forces, industrial demand and the COMEX squeeze, and macro forces, monetary policy and geopolitics. This dual support structure makes the current rally far more robust than previous historical spikes. The silver surge cannot be fully appreciated without examining its relationship with gold, its traditional monetary partner. This relationship is quantified by the gold-to-silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, the long-term average of this ratio has hovered around 50 to 1. In the years leading up to the 2026 surge, the ratio had ballooned, often sitting above 80 to 1. Indicating that silver was significantly undervalued relative to gold. This widespread was a major point of contention for silver bulls, who argued that the market was ignoring silver's dual role as both a monetary and an industrial metal. As of January 2026, with gold prices nearing $500 per ounce and silver breaking $110, the ratio has undergone a violent contraction. This is the ultimate catch-up trade in action. Silver tends to lag behind gold in the early stages of a precious metals bull market, but once it starts moving, it often outperforms gold on a percentage basis. The rapid narrowing of the ratio signals that the market is finally acknowledging silver's fundamental value proposition. For investors, the contraction of the gold-to-silver ratio is a powerful signal of market maturity. It suggests that the initial flight to safety has broadened from gold, the pure monetary asset, to silver, the monetary asset with a critical industrial component. The continued narrowing of this ratio is a key technical indicator that the silver rally has significant room to run. If the ratio were to revert to its historical mean of 50 to 1, with gold at $500, the implied price for silver would be $102. However, if the ratio were to drop to the more aggressive historical levels seen during peak silver rallies, such as 30 to 1, the implied price for silver would be $170. This calculation provides a fundamental, non-speculative target for silver that is far above the current price, reinforcing the structural repricing narrative. The current contraction is a clear sign that the market is re-rating silver as a strategic asset. The extraordinary volatility and the parabolic price action present a profound dilemma for the U.S. investor. The potential for massive gains is undeniable, but the risks associated with a short squeeze are equally extreme. The risk is a sudden sharp correction, a shakeout, that could see the price drop 10% or 20% in a matter of days as early investors take profits, and the commercial shorts attempt to regain control. This is the nature of a highly leveraged, highly concentrated market move. Furthermore, the The risk of regulatory intervention, similar to the rule changes implemented in 1980, remains a possibility, though less likely given the industrial demand component. The reward, however, is the potential for a generational wealth transfer. If the COMEX short squeeze is successful and the paper market is forced to settle with physical metal, the price could enter a hyperinflationary phase, driven by the mathematical impossibility of fulfilling all paper claims. For the average investor, the key distinction lies between the paper market and the physical market. The paper market, through futures contracts and highly leveraged ETFs, offers maximum volatility and risk. The physical market, through bullion and silver mining stocks, offers a more direct hedge against the systemic risk of the paper market's collapse. The current price action suggests that the safest way to participate in this structural repricing is to secure the physical asset, thereby directly contributing to the COMEX strain and the ultimate success of the squeeze. The decision for every investor is whether to trust the historical warnings of volatility or the fundamental reality of the supply-demand crisis. The market is offering a clear choice: participate in the paper game's final moments, or secure a piece of the physical asset that is now essential to the future of technology. The silver market in 2026 is at a critical inflection point. The question of whether this is a bull market or a bubble is answered by the data. It is a structural repricing driven by a fundamental supply-demand crisis. The bull case is overwhelming: a permanent industrial deficit, a collapsing paper-to-physical ratio, and powerful macroeconomic tailwinds. The price action past $110 is merely the market correcting decades of artificial suppression. The COMEX inventory drain is the smoking gun, confirming that the paper game is failing and that the physical metal is being claimed. The bear case rests on volatility and the potential for regulatory intervention. Traders must be prepared for sharp pullbacks and the high risk associated with a parabolic move. However, the underlying physical reality, the non-negotiable demand from solar and AI, suggests that any dip will be temporary, as the metal is simply too vital to remain at historically low prices. The $120 breakout is not just a trading event. It is a signal. It signals the end of silver ES era as the poor man's gold, and its emergence as a critical strategic asset essential to the future of technology and energy. For investors, the tightrope walk of 2026 is about navigating the extreme volatility while recognizing that the forces driving this price surge are structural, powerful, and potentially irreversible. The paper market is cracking, and the physical metal is taking its revenge. The final verdict is clear. The silver market is not experiencing a bubble. It is experiencing a revolution driven by the convergence of industrial necessity and monetary reality. The $120 barrier is the final psychological hurdle before silver enters a new, structurally higher price regime. The world is running out of cheap silver, and the financial system is running out of time to cover its paper promises. This is the new reality of the silver market in 2026.